Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, August 21, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And so we have an interesting trading day on our hands today. You can see clearly on the chart, we have what's known as a doji candle. We can also make a case that there's a tail candle involved. It has some significance for other reasons. We're going to go through the whole litany of information today because there's a couple of different things going on. A, is this an opportunity to get short the market, and why would that be a good, or why would it not be a good opportunity? And there's the other side of it is, we made a new high today. Is that important? Is that all there is? Does that mean the market reverses? Are we in an uptrend? How does that impact the decision making if we're going to entertain taking a short trade? So there's a lot of different things going on, and we're going to talk through them based on what the charts are telling us. We want to talk through them in as much of an unbiased manner as we can, somewhat and as much as we can scientific, and then I might give you an opinion towards the end, but what I'm going to attempt to do is just give you the facts as we see them and as they're laid out on the charts. Before we do that, let me just pause here and make mention that I continue to appreciate everybody's participation, making comments, posting their thoughts and important information underneath the videos each and every night. Please keep up the great work. It's helpful to me. It's helpful to you. It's helpful to the entire community. So please continue to do so. In addition, hit the like button on the video and share the video with those people you think that can benefit from this information. All right. So what do we have? We have a doji candle, and it is at a high on a chart. So to me, that's meaningful. That's something that's discussed in detail. Which doji candles are more important than others? Which tend to work out in your favor more than others? That's something that's discussed in detail in the course at Lazy E-mini Trader. Now, this is one of the ones that has some meaning. So we have to take note of it. If we're making somewhat of a Ben Franklin with a left page and a right page, positives on the left, negatives on the right, if we're talking about, is this a shorting opportunity? Let's say a positive on the right would be, it's a doji candle. That's a sign and or a signal of a short trade, or not a short trade, but a signal of a trend change. So that's an item on the left side of the page. We're at a high on a chart, another item on the left side of the page. And you see how I do this. And I do this most of the time mentally, and sometimes I do actually write it out when there's a lot of information that I have to take in, a lot of puzzle pieces that I have to put on the table. Sometimes I do actually write it out, and I want to see it in black and white or blue and white in what's in front of me. What are the positives? What are the negatives for a particular trading opportunity? So the way we go through this is we list the positives, and then we have to list the other side of the equation, which is we're in an uptrend. And most of the time, or all of the time, if we're at a high on a chart, we're going to be in an uptrend. Now, we can be at a interim high on a chart and not be in a long-term uptrend, so everybody understands that. So we could be making a lower high, and the doji has meaningful because it's at a recent or interim high on a chart. We don't like them so much in the middle of a range per se, but right here we are at a high. So that's, it's something that has meaning. It's a somewhat of a tail candle. Does that have meaning? Well, it can. It's not the greatest tail candle in the world. We'll leave it alone. Is there volume to be had? Are we making a high volume reversal? And the answer to that is no, we're not. So that's something that would be on the right side of the page of a negative ilk, because if we're talking about potentially making a short trade and we don't have a signal that has or is accompanied by high volume, that's a negative sign. It's not necessarily a positive. It's either in the middle of the page or on the right side of the page as a negative. So there's no high volume reversal at hand. So that's not helping the cause for a short trade. Now, I hate to tie in the news, but I have to tie in the news. Is there anything materially different now, and for example, yesterday, and that we might wake up to tomorrow, minus some kind of black swan event that we're not expecting? Is there anything materially different today or over the last few days than has been over the last week or 2 or 3 or 4 or 5? And the answer really is no. We have some interesting information that came out today on Trump's personal or former personal lawyer, Michael Cohen. Apparently, he's either cooperating or not cooperating with the Mueller team and the FBI. Who knows what's going on over there? That's really just a soap opera. There's been so many things that the media has gone frenzy about that was going to impact Trump, and none of them ever have. So until one of them does, we're going to brush it off like the market normally does and say it's likely a non-event. All right, so we listed a couple of positives. We listed a couple on the other side of the page that might warrant some caution on a short trade. The other question is, how do you do it? For those traders that have been around a while, know there's a pretty simple garden variety way to take a trade like this. We're relatively close to risk. What does that mean? Well, the Spider, for example, and you can use any other vehicle you want, some of these leveraged exchange-traded products, options, whatever it is. But the way it's done is this. The Spider today is at 286.34 on close. Now, the high today, we did make a new intraday high. We did not make a new closing high. That does have some importance, but that's not to say we can't make a new closing high tomorrow. Remember, we are in an uptrend. But here's the way you would take a short trade if one trader was going to take a short trade or was interested in taking such a trade. The high is 287.31. And the way this is done off the daily chart is any close above. So, for example, if we were to close above that number, meaning today's high, if we were to close above there tomorrow, then that short trade that you would have taken tomorrow at some point during the day would be off the table. You would have to close out the trade if the market was closing above today's high, or any day after today, or meaning after tomorrow. So that's the way that trade is done. So you stay in the trade until and unless you close above today's high, or unless you hit a profit target on the downside. Being close to risk means that you don't have to risk a lot in this trade. Remember, today's high was 287.31, so it's basically $1 away, roughly, give or take, $1 away from where today's closing price is. In the big scheme of things, in an index that's priced at $286 a share, $1 of risk is not a lot of risk in percentage terms. Now, the next question is, would you be short? Would I be short is the question. And the answer is, on a trade like this, it is worth the risk. I'm not risking a lot. I would generally do it with options. I did take a short position. I know you would have liked to have known that before the closing bell today. I get that. I understand. There's a gap of information. I'm aware of it. However, let me give you the thought process on why I did such a thing. We made a new high today. We did not make a new closing high. Like I said before, we could make a new closing high tomorrow or the next day. That's not really the issue. The issue is this. Now, we did come close. We pulled back, meaning close to the all-time highs before. We pulled back, and now we're coming back up to it, and one would think, well, we're just going to blow right through it. We had a pullback, and now we're going to blow right through it. And here's the deal. For $1 risk on a $286 index, it's small in percentage terms. There's other ways to trade it, other vehicles to use. You can use options by buying a put option, for example. You buy a put option, you know your total risk, and you can say, look, I'm willing to give this trade X number of dollars of risk, and if it goes in the other way or out of my favor, I'm going to close out the trade, and I'm willing to take risk of $200 or $400 or $2,000 or whatever the number is that makes you comfortable. Each trader listening to this is their own individual trader, has their own account size, and is willing to take on their own type of risk. So one's risk is somebody else's, different risk for somebody else. So the point is, here's what I'm saying. For $1 risk, I'm willing to bet they're not going to break out on this run, and I can probably catch a pullback for a day or two, potentially more. I may take half off if I get the pullback and see if we get more of a pullback. I'll play that by ear. I'll take it trade by trade, day by day. But right now, I have a small position using a put option that I am short the market, and I will do it against today's high. If I'm wrong, and that's okay. Sometimes it takes a few cracks at trades like this, and this is what I mean. There will come a time at these new highs where the trade will work, and it will be the ultimate high, and there will be a high volume reversal that I'm able to hop on and ride down. I may not be the first one in the trade, and that's okay. We don't have to be the first one to the party. We just have to be at the party while everybody's having fun. That's the objective. So if we don't have to top tick everything, we don't have to bottom tick everything, we need to get the direction right, and we need to have the timing reasonably correct, and you'll win the majority of the time. That's the way this business works. I'm aware of the risk on this trade. If it doesn't work, I'm willing to try it again at a different price, at a higher price. Maybe I'll get the high volume reversal and I'll actually have a higher probability trade on my hand. I know the probabilities of this trade. I know the risk. I know where I'm wrong. I'm willing to take the risk. I took the trade. Otherwise, from a long-term perspective, look, nothing's changed. When you look at the weekly chart, this market is just in a very strong uptrend, approaching old highs. Are we just going to blow through the old highs at this run? Or is it going to take a while? Are we going to get rejected, consolidate for a while, have a correction for a week or two or three? There's no telling exactly how it's going to shape up. It should become more clear over time. Each and every day it will become clear, but each and every day we have to put the puzzle pieces on the table. Today, the puzzle piece in the spider that goes on the table is a doji candle, and it may be good for a pullback for a day, 2, 3, or 4. We'll see what happens. Maybe it develops into something more. One day at a time. I'm not worried about next Wednesday. Here's the other side of the coin, right? Here's a bullish chart. We talked about it last night. Specifically, we talked about something last night, and this is something that's taught in the course at Lazy E-mini Trader. Now, it's something valuable, and it's one piece of information among many others that's taught in that course. If you think this piece of information is valuable, then you need to come over and check out the course, because there's a whole host of and litany of other like pieces of information that prove to be invaluable when trading in and investing in these markets. It doesn't matter whether it's from an intraday 10-minute chart perspective or a weekly chart, hourly chart, daily or monthly, makes no difference. Now, here's what we talked about last night. We talked about the breakdown candle. And here's the breakdown candle. It occurred on the 27th of July. And I said the fact that we closed above that breakdown candle, that's a bullish sign. We've been waiting for that. I said as long as this remains in a bearish wedge formation, it's susceptible to a move down to complete the pattern. We talked about that about a dozen times. And then I said, however, and we began talking about it each and every time we get up to the top and to test the top of the breakdown candle. We talk about this every single night, these breakdown and break up candles. They're like gold. And I said, if we close above the high of the breakdown candle, the bearish pattern is off the table. Well, what does that mean? And we talk about this all the time. It's another thing that I mention over and over and over again. It's the fact that the market is made up of energy, and the energy is going to be released in one direction or another. If the market is making a bullish consolidation pattern, the market is going to release the energy in a continuation format or to the upside. That's the bullish continuation pattern. Energy is being released in the upward direction after consolidating. The flip side is true. If the market is consolidating in a bearish formation, the market is going sideways and the energy will be released in the downward direction, hence completing the bearish formation. Well, if this pattern on the IWM daily chart was making a bearish formation, that means that this energy was ultimately going to be released to the downside. Well, guess what? We closed above the high of the breakdown candle. What happened to the energy? It went in the other direction. We talk about this all the time. Why do we talk about this all the time? For two reasons. Because we see it all the time, so it gives us something to talk about all the time. And if we're seeing it all the time and we're talking about it all the time, then you can also be able to recognize it all the time, either as it's happening or before it happens, and take advantage of it. That's the whole point of the course. I'm giving you these things in order to recognize what the market is likely to do the highest percentage of the time, the highest probability of the time. Being able to recognize those things gives you the ability to place trades where the odds are in your favor, where you can win the majority of the time. Recognizing that you're still going to lose some of the time, and when you do, you can lose small and fast, because you're also taught how to lose small and fast by recognizing where you're wrong. These are the things that are in the course. It's very simple. It's what I like to teach. It's the way in which I teach, and it's become successful for many, many students out there. Don't take my word for it. Look at some of the comments that appear on these videos every single day from students that have taken the course. They're finding success. Kudos to them. Thank you for posting your successes. It gives others hope that money can be made in these markets if approached properly. Okay, I'm sorry to get on that soapbox. I get excited sometimes because I have a passion for what I do. All right, back to the IWM. So this is bullish. We're at highs, right? So this is breaking out. This was a long consolidation pattern. Let's get this bird's eye view from the weekly chart perspective. We talked about this before, not just once, not just twice. We looked at this a number of times. Where do you think the 162.48 came from? It's the low of the breakup candle from the weekly chart. And as long as we stayed inside of that number and we consolidated sideways, the odds favored that we were ultimately going to break to the upside in a continuation formation, just like we discussed a minute ago. Now, let's go back to the daily chart and have a discussion about something. Why in the world would I take a short position in the spider when the IWM, which is your favorite market leading indicator, breaking out to the upside? Why in the world would you take a short position when this is going on? Are you bananas? And maybe I am. The answer is potentially I could be bananas. Let me give you the rationale. I'm not going to give the short trade much rope. I took the trade because it's part of the rule book. It's set up. Obviously, no trade is a trade. I could have kept the money in my pocket. I took the trade. I know where I'm wrong. The risk is small. My guess is, and this is a guess, right? This is not anything having to do with a technical attribute on the chart. My guess is that the IWM is probably going to peter out, pull back a little bit. We just busted out to the upside. We had a nice big up day, way outpacing the other markets. The spider was basically flat on the day. The S&P 500 was up 0.2%, and the IWM was up 0.8%. So yeah, we're breaking out, but even one day that we peter out can give me the gains I'm looking for on the spider. That's all it is. It's just a trade. Even though it's classified, because technically I'm holding it overnight, so it's classified as a swing trade. Folks, just understand, I'm looking for a trade. If I can be out of this thing by 10 o'clock in the morning, I could be out of that trade with a profit. That will be perfectly fine with me. It's just a trade. Now let's look at the VIX. So we looked at the IWM and we said it's breaking out. Why would you take a short trade? Now let's look at something else. Again, we're always looking at both sides of the market. So here's the VIX. Now, the market, all in all, across the board, was slightly up today. The Dow was up 63 points. The Nasdaq was up 0.5%. The S&P was not that much, but up 6 points, up 0.2%. And the transports were up 0.6%. We haven't got there yet. And the VIX was basically flat. That's interesting. Why wasn't the VIX down? Is this a bullish pullback pattern? Are we setting up to go higher? Is this potentially an ABC pattern in the making? A leg up, B pullback, a pullback pattern, hence the term pullback pattern, and a C leg higher. That's possible. I don't even know if it's probable. I'm not suggesting it is probable right now at this stance. Right now, we're below 3 out of the 4 moving averages that I like to use. I'm just saying, when I look at this chart, I don't necessarily see the same thing or mirror image that what we just looked at on the IWM. If we saw a mirror image of the IWM, because the VIX would be doing the mirror image of what a market breaking out would be doing, the VIX would be struggling, it would be bearish, it would be breaking down. That's not what I see here, so that's interesting to me. Did it play a role in me taking the short position in the spider? Yeah, it played a role. It wasn't the deciding factor. It was a puzzle piece on the table. The transports, look at this breakout going on, okay? So here's like the IWM, we have a market, my second favorite market leading indicator is on a breakout. Is it overextended? Yes, it is. Did this play a role in some way, shape, or form in my short trade that I took in the spider? In a roundabout way, it did. It's on a breakout, it's bullish. That's not really why. It's overextended. Could that have played a role subliminally? Is that a word? I think I said that wrong. I'm not even going to try it again. In the back of my mind, it did. It's extended. Look how far away it is from home base. What's home base? Home base is the 20-period moving average. Why is it called home base? Because we know that markets, whether we're looking at a daily chart, an hourly, a 10-minute, doesn't make any difference. They don't like to get too far away or extended from home base. So we're extended in the transports. Are we likely going to pull back? Yeah, but we can go 200 or 300 or 400 points higher before we pull back. I'm fully aware of that. So I'm not suggesting that that in and of itself played any real role in me taking the short trade on the spider. But I just want you to know that I looked at everything. These are my thought processes. And I've told you before, being inside my head is a very dangerous place to be. But we have an overextended transport. So long-term view, we're on a breakout. Who knows where the top is? We don't know where it is right now. We have no indication of a reversal in the transports whatsoever. Not now, not here, not today. Doesn't mean we can't have a down day or two, but right now, this is on a breakout. Higher prices are indicated. Everything is pointing higher. The trend is your friend until the very end. The Qs. Now, here's interesting on the Qs. Now, I haven't looked, and purposely, I'm not going to look. I don't really care. Something must have come out news-wise after the closing bell. The Qs closed at 180.36. As I make this video, they're printing 179.57, 58, 68. In that neighborhood, there's a bit of a spread. So the point is that for some reason, technology is forcing the Qs down after hours. I don't know whether that will hold true by the opening bell tomorrow, so it's not important right now. What I want to do is I want to look at the chart based on today's closing price. That's what's apropos. Anything can happen between now and 9:30 a.m. Eastern Standard Time tomorrow morning. So today, what we have is a couple of things going on. We're still above, and that's a good sign, the 20-period moving average. Although, I'm not holding that much stock in the 20-period moving average by itself because we've been back and forth in and around the 20-period moving average for the last several days. That diminishes the importance of that moving average. So we're above it, fine, that's positive. I can make a case that we have a bullish consolidation pattern. Let me get my hefty drawing tool or trusty drawing tool. So we have an up move and we have a pullback pattern. We're above the moving average. We're above all the moving averages. That's bullish. This is a bullish daily chart. We also have something else that's on the bullish side of the equation is we've already closed above on this chart after this breakdown candle occurred. We've now already closed above that breakdown candle. Now, that doesn't necessarily mean each and every time that happens, the market's going to immediately go higher. We talked about it and we saw before what happened in the IWM, but it is an indication. We have discussed this many, many times before, so it is of value. We've seen this work many, many times. It just doesn't necessarily happen right away. So we have a bullish pullback pattern. That's positive. We're above all the moving averages. That's positive. We have closed above the breakdown candle high. That's positive. We're not breaking out to new highs. That's interesting. Is it negative? I don't know yet. It may be negative. We're breaking out to new highs in the IWM. We made an intraday high, not a closing high, but an intraday high in the spider. We have an index in the Qs that is top heavy certain stocks, so that does play a role. If I look over at the stocks that do overweight the Qs, is anything materially changed today? Not necessarily. You know, there's a few that were down, but nothing big, nothing high percentage down. Some down, some up. Some down not so much. 40 cents on Facebook, not a big deal. Amazon was down $5, but that's only 1/3 of 1%. So it's no big deal one way or the other. But something is amiss with the Qs, I would think, because similar to the IWM, and here's the risk asset part of the discussion. So money that is destined for riskier places to be. So I have a bucket of money, right? There's money that's safety money, money that I'm willing to take some risk with, money that's willing to be somewhat illiquid, like that goes into real estate type investments. And there's a portion of money that's destined for risk assets. Maybe for some people that just means the stock market. For others, that means portions of the stock market. In the case of the IWM and the Qs, meaning the technology sector, that's a riskier part of the market than others. So when I say the risk assets are on, meaning the IWM is breaking out, risk on, money is running into risk assets, that generally holds true for the triple Qs, and that's not happening right now. So can it be a canary in the coal mine? I'm not 100% sure one way or the other right now, but I'm watching it closely. I've got my eye on the Qs closely. All right, we have to move it along. I know this video is getting a little long in the tooth. The XBD. Now, the XBD was down a little bit today, but and I'm not 100% sure whether these or all of these are components of the XBD, but some of the broker-dealers were down today on some news that I think it was JP Morgan is coming out with some electronic trading platform that's going to compete with some of the broker-dealers out there. It will compete with some and not with others, not with high-profile trading platforms, and it might compete with stuff like Schwab and E-Trade, where people are just looking to buy some shares and sell them later, not looking to necessarily trade in and out of stuff. That's reserved for trading platforms. So there's segments of that business. So I'm not holding much stock in the fact that the XBD was down today because I think that news is really a bunch of nonsense. XLF was flat, so we'll take a cue from the XLF, and we're basically right back to the highs where we were a week and a half, 2 weeks ago. So can we make anything out of that other than the fact that we're still working to get through these old highs? That's what it's doing. So we have some highs from back here, and we made an attempt them here, and we didn't get through. We were rejected. Now we've come back to make another attempt at those same highs. This is a breakdown candle. That's the market's way of telling us that price level is important. That's why we found resistance here. That's why we found resistance again. That's why we found resistance again. Eventually, we'll be able to get through there. Is it going to be tomorrow, or is it going to take some more time to build some energy to get through that price level? Time will tell. Likely, we will get through that price level. Longer term, we know the XLF can go higher and still remain in a longer term bearish pattern. It's in an interesting position. The daily chart says one thing, the weekly chart says something else. So from a daily chart perspective, we can be long an index that's saying it's in a daily chart uptrend, just recognizing that we do have an upside target that once reached will likely reject the market, where the market will likely find overhead resistance, and that's that weekly chart resistance area that we've been discussing. We'll talk about it at the end of the week. At this point, we can just move it along. And from this point, we'll go over to the gold market. Wait, before we do, I made a promise. I had a request to go over the DAX, and I don't have an appropriate chart of the DAX or DAX futures chart to go over. However, we can use the EWG, and I think it's sufficient. So basically, this is different than the U.S. market. So this is basically an exchange-traded fund that tracks the German broader index, the DAX. Now, this doesn't look like the U.S. market. You can see very clearly here, we're in a downtrend. We're below all the moving averages on a daily chart. Now, we did have a nice little rally here off this low from a few days ago, but this is just, in my opinion, looking at the chart, a dead cat bounce in a downtrend. When you look at the weekly chart, you can see here that we didn't quite fill this gap. And let me point it out with the pen. So you see this gap down here. We didn't quite fill that gap. And I think it would have been better off for this particular chart on the weekly chart basis to have filled that gap and would have caused what I think would have been a different type of, or potentially even more robust rally off of a filling of that gap. Now, we didn't even hit the 200-week moving average. What that tells me is one of two things, and we have to make a decision one way or the other. There's always two ways to look at a chart. A, it could be a sign of strength, and because the market was buoyant, it didn't reach the 200-period moving average, and it takes off in the upward direction away from the 200-week moving average. That's possible. The other side of that is it didn't reach it, it's going to make another attempt, and the only way that we're really going to know that for sure is where the market goes and where it fails. And the only thing we have to play by right now in the way of rules in terms of the weekly chart is the weekly 100-period moving average. So if we get above and close above on a weekly basis, this 100-week moving average right now on the EWG comes in at $30.41, so it's not that far away. If we close above there, that's definitely a positive and a step in the right direction. And if you look at where that is, that gets us above the 20-week or 20-day moving average, and it gives us a run for the 50-day moving average. And you can see most likely some natural overhead resistance right here. This is where the market broke down. There would be some more up here. But the daily chart and the weekly chart are definitely in downtrends. If you want to look at it from a longer term perspective, and I apologize for this video once again, long in the tooth, long in the tooth. From a long term perspective, you know, here's your 50-month moving average. Is this going to hold, and are we going to take off from here and have a whole nother leg up for another few years? That's possible. There's really no way to know that. That's why it's very difficult to analyze, in a lot of cases, the monthly chart. Sometimes we see a pattern very clearly on a monthly chart. We say, here's a bullish pattern, here's a bearish pattern. Just be aware it's going to take a long time to play out. But right now, we don't know whether this was just a bullish pullback pattern on the monthly chart, getting ready to take off in a multi-month rally higher, or is this going to continue lower, and are we going to bust through on the downside the 50-month moving average? We just don't know that, so the monthly chart really isn't telling us much. And while we're on the topic of EWG, I might as well bring up DG. And it's at the expense of this video getting way too long. Not DG, DB. It's Deutsche Bank. And Deutsche Bank is the largest banking institution, if not in Europe, certainly in Germany. And I guess now is as good of a time as any to make a comparison to some of the U.S. banking institutions. Now, we said already that Germany didn't look like the U.S. market. The chart was different. It was in a downtrend. U.S. markets are in an uptrend. That means that there's something different going on in the German markets, in the German economy. Germany, something different is going on there than there is in the U.S. and other places for that matter. There's other markets that certainly look much healthier than Germany. But look at Deutsche Bank. So on the daily chart, you can see it looks somewhat similar, and you can't really tell a whole lot from the daily chart, but you can see where there is some similarities to the daily chart of the EWG or the ETF EWG that we looked at just a minute ago. But look at on the weekly chart, okay? Now here's a distinct downtrend. We're below all the moving averages. And on the monthly chart, and then I want to compare something with you. Look at the monthly chart. This is basically minus a few pennies here and there, or maybe $1 here and there. Here's a low of 11.19, okay? What's a recent low? 10.36. We're at 11.54. So we're within $1 of all-time lows on this chart of one of the most important banking institutions in Europe, certainly the most important banking institution in Germany. Now, how does that stack up to JP Morgan from a United States or U.S. standpoint? Well, look, we're not at all-time highs, but we're pretty close to all-time highs. Let's just look at the weekly chart. Anything wrong with this chart? Absolutely not. How about Bank of America? Anything wrong with this chart? No, could be a bearish pattern developing, but we're still near the highs. I mean, this is a healthy chart. Goldman Sachs, may not be at highs, but certainly not at lows like Deutsche Bank, okay? $238 a share. Maybe the highs were 270 something, but still very healthy from a long-term perspective. Now, this may not be the most healthy weekly chart, and there may be a trade in here coming up. I didn't notice this weekly chart. I'm going to do some more work on this, but there could be a weekly trade coming up here shortly. Not necessarily tomorrow, but at some point in the near term, there's a weekly short trade coming up here. Remember our friend the XLF. This is a good proxy for the financial sector, or at least in part of the financial sector. And here we go, XLF, not necessarily at highs. We know about the weekly chart scenario, but certainly on the daily chart looks pretty good. And when you compare the financial sector in the U.S. to the financial sector, or at least the financial institution, Deutsche Bank in Germany, and take into account the German market that we just looked at, German market does not look healthy, and that's your long-winded answer of the request to review the DAX. All right, we'll run through the rest of the stuff here. Gold. So gold is above right now. We'll have to see where the official close becomes, but we're above a breakdown candle high, $1,202. We're at 1,202.7. So we'll see where the official close is. That'll give gold the freedom to trade a little higher, likely into the 20-period moving average, potentially slightly higher, making a run for the next, what? Yes, breakdown candle high, and also a former consolidation area. You see how it works? It's like stair steps or a staircase. We take one step at a time. The market moves up steps at a time. It moves down steps at a time. Sometimes we can see the steps more clearly than others. Right now, on this daily chart of the gold market, I can see that closing above this last breakdown candle high will likely give the market the ability to trade up to, or at least toward, the 20-period moving average, and potentially slightly higher in this area of the next breakdown candle high. That's just the way markets work over and over and over again. Doesn't matter whether you're on a daily time frame, intraday 10-minute chart, weekly, monthly, hourly, makes no difference. Looking at the chart of crude oil, you can see here that we're still making a bearish consolidation pattern in crude oil. We're below moving averages. We can get rid of this. We no longer need this stuff. I think we actually even rolled to another contract in crude from what we were looking at. We're just going to take everything off the chart and we're going to look at it like this. Here's a bearish pattern. We're below the moving averages. We're below 3 out of the 4 moving averages that we look at, the 100, the 20, and the 50. And until and unless we can close above the high of this breakdown candle, $66.32 a barrel, we're at 66.07. Until we can close a day, the daily chart close above that level, this is susceptible to another leg down. That's what happens in a bearish pattern. And with that, folks, I'm going to give it a wrap here. I'm out of wind. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.